Welcome to your Mortgage Insider update for this Veterans Day, November the 11th. The government shutdown nears an end. The Senate's going through their series of votes that will come up in the House, and it looks like the government shutdown will be the longest on record, but will be over by the end of this week, God willing. So that will reopen some of the programs. The only main mortgage program to really be directly affected would be the USDA rural housing. There's require actual government workers signing off prior to funding one of those loans. Other, departments that need to be open to help mortgages, the IRS for tax transcripts. There has been a lot of hoops to jump through trying to work around the fact that you cannot get direct tax transcripts from the IRS website. So that should open things back up, but potentially open us up for all the data that we've been missing that could lead us to further lower rates if we can confirm the economy slowed down. There has been a series of big companies announced lots of layoffs, but until those show up in the unemployment numbers, which we haven't seen for a bit, we'll start to really lay out the case for the next meeting for the Fed in December after the Thanksgiving holiday. So let's take a look, see this morning what the charts are doing. Wish you a great day. Take a look at the 10-year Treasury bonds. The yield on the 10-year Treasury tracks a 10-year period. It's pretty long, with most mortgages lasting less time than that. Most people pay off early by selling or refinancing their loan. We're going to look all the way back to October 1st at the beginning of the government shutdown. Like I said, it's about to come to an end. But as the beginning of October rolled into the Fed meeting, we had a lot of anticipation. Interest rates kind of in advance pulled back, even though there was hope that the government shutdown would not last too long. We had most of the data the Fed needed to make their decision. And of course, they made their decision. We saw the interest rates move up. So it's been a volatile few weeks since the Fed meeting. We see, the spike in interest rates and then, the fall here just in the last week, starting to settle down right above this 50-day average. So in general, 10-year Treasury at 4.11% was down below 4% just a short while ago. Could we get back there with the government reopening and some of the data points that were missing for the last few weeks, which, risk calculators would say, like, if you don't have the information, shy on the side of caution, which pushed interest rates higher to the bond investors. They are willing to pay less for the bond. So that's putting pressure on interest rates. Could that pressure reverse and we get a lot of wind in our sails? We know the Federal Reserve is going to start to change their policy in the coming month, December 1st. They will start to end their runoff of their balance sheet, meaning if you have a mortgage and even if you had a 3% interest rate, if the Federal Reserve owns that loan, when you sell your house, pay them back, they're going to take that principal now. They're not going to reinvest it in mortgages. They're going to invest it in these treasury bonds. Potentially, the long-term treasury bonds is one place that they could apply pressure to drive interest rates down. If there's more buyers in the marketplace, that could drive the interest rate down. So there will be more money staying in the system with the Federal Reserve removing their balance sheet runoff starting December 1st. That will come ahead of their actual meeting in mid-December. So, as always, we're going to keep an eye on this each week with an update. We hope to have a lot of better information for you as the government shutdown comes back offline. We will start to get a lot of the back reports. We did get the one consumer price index report that was needed for Social Security cost of living increases here during the shutdown. But following up, we'll start to see PCE, which is the Fed's favored measure of inflation. That report can now be released. The producer price index, which tells us a little bit more about the future, what producers are paying in their inflation or deflation. There's a lot of folks that feel like the total inflation rate just over the last 6 months has really slowed, and that could be an upper hand in the coming months as we start to get into the winter months, where a year ago inflation had spiked up just a little bit right into the beginning of the year. And so if the year-over-year inflation is minuscule at like 0.1 to 0.2% on an annualized basis, that will bring us down well below this 3% annualized basis we've been showing under the consumer price index. I think it was 2.9% at this last go. So hope ahead, but don't hold your breath. Have a great one.